AMC just reported its biggest Eastern weekend when it comes to revenue, and the stock responded. It went up over 12% in just one day. And the question is, could this trigger the next massive short squeeze? Well, in this video, we're going to go over the latest news, the fundamentals and the technicals, and we're going to find out whether this is still a great buying opportunity for the long-term investor. So buckle up and let's dive right in. We're now looking here on the chart on TradingView for AMC, and we can see that AMC is now trading at a roughly $1.27 in the pre-market. We can see it closed above the 50 EMA, and this is a very bullish signal. However, the overall trend is still down, and my average cost price is around $1.75, so I'm still underwater. So in this video, we're going to go over the fundamentals and latest news to find out what the probability is that we will fly all the way up and whether this company is still very cheap. And then at the end of the video, we'll come back to the charts to make a conclusion. AMC is the largest movie exhibition company in the world with over 850 theaters. And here we can read the latest news, which we can see here. So here we can read AMC Entertainment delivers best ever global revenue mark for a 5-day Easter weekend, led by the Super Mario Galaxy movie, strong merchandise sales, and solid performance by other titles. So what is this movie? Well, the Super Mario Galaxy movie is basically a movie that's based on Nintendo's Mario franchise, the games, and it's doing pretty well, which is very interesting to see. And this is good for the company. We can read here that there were more than 6 million moviegoers attended AMC theaters in the United States or Odeon cinemas internationally from Wednesday, April 1 through Sunday, April 5th. And this was also AMC's highest global attendance for Wednesday through Sunday in 2026. So not only this Mario movie did well, many movies from before like Project Hail Mary and Hoppers were also doing pretty well, which is good news. In short, this 5-day Easter weekend was doing really well, and they achieved the highest combined global admission and food beverage revenue for the holiday frame in AMC's 106-year history. All in all, very good news. So the big question is this the beginning of a massive short squeeze? Well, in order to know, we need to look at AMC Entertainment short interest ratio and short volume. And we can see that the short percentage of float is 22%. So everything above 10% is actually pretty high, but high percentage of float is normal for these type of stocks. AMC was one of the original meme stocks, and it was heavily shorted before as well. So here we can see short percentage of float, and we can see in the last few months it went all the way up, but now it's going down a little bit. So it's now a little bit stable, but like it's floating around 20%. So that's definitely enough for at least a medium-sized short squeeze. And the short interest ratio is 4 days, which is plenty of time, which shows that this is like the time it takes for the short positions to close. So all these short sellers have to buy back the shares, and this will push the prices even higher. So absolutely enough short percentage of float for a medium-sized short squeeze. In short, I think that there's definitely a probability that this can climb higher and that the short sellers are forced to buy back their shares in order to avoid more losses. Is AMC a great financial company? Well, we are looking on Guru Focus to get a quick financial overview. So they gave it a 50 out of 100, which is not too good. It's pretty average or even below. And here we can see, if we look down, that the financial strength is not too bad. They have a lot of debt, and they use like ATM strategies to sell at the market, which creates lower stock prices because they create more shares. So more shares in circulation is less value per share. And this is definitely a concern for investors. They're not too profitable, but their revenue is pretty solid, which we can see here. So we can see here that the revenue has been increasing, and now with this record Easter weekend, we can see even more revenue in the future, and that's definitely a positive sign. But the net income is still negative. We can see that the debt is decreasing, which is also a good sign, but the debt is still way too much compared to the cash. And like strategies like ATM isn't going to solve everything. So it's still a little bit of a risky company, I would say. AMC is a high risk, high reward company. But if we buy when it's undervalued, then we have a margin of safety. So the question is this company cheap or expensive? Well, if we look at the price to sales ratio, we can see it's 0.14, and that's pretty low. But what does that mean? When a company isn't profitable, they don't have positive earnings yet, but they do have revenue, how do we value the company? Well, we can look at a simple metric which is called the price to sales ratio. And what is the price to sales ratio? Well, essentially it's the market cap divided by its revenue. And this tells how much investors pay per dollar of sales. In short, if the company has a lot of revenue and a relative low market cap, then we could say that the company could be undervalued. based on the price to sales ratio. In short, the price to sales ratio of 0.14 for AMC is really low, and this shows that they're making a lot of revenue compared to the market cap. So the market cap, the stock is very low compared to the money that they're generating. And if we look to the comparison to the competitors, we can see that even in the industry, it's pretty low at 0.14, and there is a margin of safety based on the price to sales ratio for sure. Another thing that we need to know about AMC is whether it has a strong, wide economic moat. Does it have a competitive advantage? Well, I made an economic moat analyzer to find out. So here it is. It's based on Warren Buffett's framework, and we can type in AMC, for example, to find out whether this company has a strong economic moat. Well, based on this economic moat analyzer, it isn't the strongest. It's a 3 out of 10, so they do have a little bit of a moat, but it's not the strongest yet. So their strongest suit is the brand power. They do have a little bit of brand power because they are like the largest in the world, and it's very recognized. But there are a lot of competitors. It's highly susceptible to price and convenience. It's not too much switching cost or network effect, but they do have some cost advantages. So the verdict: AMC operates in a highly competitive and disruptive industry with minimal sustainable competitive advantage. The company lacks the enduring characteristics of a true economic moat, making it vulnerable to market shifts and new entrants. So they don't have a wide economic moat yet, and that makes this company a little bit more risky, and that's very important to keep in mind, and that's why we shouldn't go like all in into this company, because the moat isn't like the strongest yet. So here are the strengths, like largest cinema chain in the world by numbers of screens, established brand recognition within the cinema industry, strong relations with major film distributors, diversified geographic presence, so they're all around the world. But the weaknesses like high fixed costs associated with real estate and operations, intense competition from streaming services like Netflix, for example, and home entertainment, low barriers to entry for alternative entertainment options, and highly susceptible to economic downturns and changes in consumer habits. If there is a crisis, people are going to spend less on things like, for example, going to the cinema, but people will always spend on food, for example. So it's not like the priority when it comes to survival. So if there's really bad times, then this can also go. Then this is also not really good for AMC. AMC has always been a meme stock from the beginning, together with GameStop, and people are still very bullish. You can see here on stock tweets as well. And if we look here at the sentiment, we can see that it's extremely bullish right now, and the message volume is very high, which could be an indication that this bullish rally is more likely to continue based on the sentiment. Even if we're really sure when we invest into a company, it's important to avoid these 3 mistakes. So the first one is leverage. Don't use leverage. Don't borrow money from brokers to invest, because if we use leverage and the stock collapses, then we're obligated to sell our stocks, and this is called a margin call. We want to avoid that, and the stocks we invest in are already volatile enough. The second mistake is don't break your allocation rules by wide margins, which means that you allocate too much to one company because you're really sure about this company and less sure about that company. Try to allocate the same amount, but don't over allocate into one company. And this goes to the last mistake that people have, is don't fall in love with one business or stock. Don't go all in into one company because you're so sure. You can never be 100% sure. So never fall in love with one business or stock. In short, always avoid these 3 mistakes at all costs. We're now back here on the chart, and it's now trading at $1.23. The market just opened, and we can see here that my average cost price is at $1.75. And I'm just going to hold. I will just wait for at least a few years, because I think that the true value of this stock is much higher. And of course, it doesn't have a wide economic moat, and it doesn't have the strongest fundamentals, and they do have a lot of debt that they have to fix. But I think that the market cap is now so low compared to the revenue, so the price to sales ratio is very low, and that gives me the confidence that if you buy now, you have a margin of safety. And I'm bullish on this company. I think that the hype could push this price even higher, and especially with high short interest, there might also be a short squeeze coming soon. So with that being said, of course, always do your own research, always do your own due diligence. This is just for educational purpose only. But if you like this kind of video, feel free to like and subscribe. I would really appreciate it. And I'll see you in the next video. If you want to learn how to master stock analysis like a pro and find winning stocks and beat the market so you can build a portfolio that consistently wins, then feel free to check the link in the description down below.